Did you know that a single number, your credit score, can determine whether you get approved for a mortgage, a car loan, or even a job? In fact, a high credit score can save you thousands of dollars over your lifetime, while a poor one can trap you in a cycle of high interest rates and financial struggle. But what if I told you that this seemingly straightforward number is actually part of a complex, often opaque system with a dark side? Welcome to the Mechanics of Money, where we make sense of the most intriguing money questions. In this episode of The Mechanics of Money, we'll explore the hidden truths behind the credit score system, its origins, how it's manipulated, and the impact it has on millions of lives worldwide. Let's start at the beginning. The concept of credit scoring isn't as old as money itself. It was developed in the mid-20th century, during a time when consumer credit was exploding in the United States. Banks needed a way to quickly and reliably assess whether someone was likely to repay a loan. Enter the credit bureaus, companies like Equifax, Experian, and TransUnion, that began collecting data on individuals' borrowing habits. The first credit scoring models, like the FICO score introduced in 1989, revolutionized lending. Instead of relying solely on a lender's intuition or limited financial history, banks could now use a standardized score to make faster decisions. This system was initially praised for its efficiency and objectivity, but beneath the surface, it was also creating a new form of financial gatekeeping. Fast forward a few decades, and the credit score has become a central pillar of the financial system. It influences not just loans, but insurance premiums, rental applications, and even employment opportunities. But how fair is this system really? While credit scores are designed to be objective, they're far from perfect. In fact, they can be manipulated, biased, and even unfair. For example, some people with stable incomes and good financial habits still struggle to improve their scores due to systemic issues or errors in their credit reports. One way scores are manipulated is through credit piggybacking, where individuals are added as authorized users on someone else's credit account, sometimes without their knowledge, to boost their score. This practice can be exploited by those who understand how scoring models work, creating an uneven playing field. Moreover, the algorithms behind credit scoring often incorporate factors that can perpetuate inequality. For instance, a person who rents rather than owns a home might have a lower score because their rent payments aren't always reported to credit bureaus. This can disproportionately affect minorities and low-income individuals who are less likely to own property or have access to traditional credit building tools. There's also the issue of errors. Credit reports are riddled with inaccuracies, wrong addresses, outdated information, or even fraudulent accounts that can unfairly damage someone's score. Despite regulations requiring credit bureaus to correct errors, many consumers find the process opaque and frustrating. In recent years, the dark side of credit data has expanded beyond traditional reporting. Hackers and cybercriminals have targeted credit bureaus, leading to massive data breaches. For example, the Equifax breach in 2017 exposed sensitive information of over 147 million Americans, including social security numbers, birth dates, and addresses. This stolen data can be sold on the dark web, where identity thieves use it to open fraudulent accounts or take out loans in someone else's name. Victims often discover these crimes only after their credit scores plummet or they're denied credit. The process of clearing these fraudulent accounts can take months or even years, leaving victims in a state of financial limbo. This dark web activity underscores a troubling truth. Your credit score isn't just a reflection of your financial behavior, it's also vulnerable to malicious actors who can manipulate or destroy it. The consequences of a flawed or manipulated credit system ripple through society. For individuals, a low or damaged credit score can mean higher interest rates, larger down payments, or outright denial of credit. This can prevent people from buying homes, starting businesses, or even securing jobs. On a macroeconomic level, the reliance on credit scores can contribute to economic inequality. Studies have shown that minorities and low-income groups often face systemic barriers to building good credit, perpetuating cycles of poverty. For example, a report from the Urban Institute found that Black and Hispanic consumers are more likely to have lower credit scores, partly due to disparities in access to credit-building opportunities. Furthermore, the credit scoring system can exacerbate economic downturns. During financial crises, people's scores often drop sharply due to job losses or missed payments, making it even harder for them to recover financially. This creates a feedback loop where economic hardship leads to lower scores, which then restrict access to credit needed for recovery. Given these issues, there's growing debate about how to reform the credit scoring system. Some advocate for more transparency, making the algorithms and data sources open to scrutiny. Others suggest expanding the types of data used to assess creditworthiness, such as rent, utility payments, or even social media activity, to create a more holistic picture. Innovative companies are already experimenting with alternative scoring models. For example, some fintech firms use machine learning to analyze a broader range of financial behaviors, aiming to include those traditionally excluded from the system. The goal is to create a fairer, more inclusive system that reduces bias and errors. However, these efforts face resistance from established credit bureaus and financial institutions that benefit from the current system's opacity and control. The challenge lies in balancing innovation with privacy, security, and fairness. Looking ahead, the future of credit scoring could involve a shift toward decentralized, blockchain-based systems that give consumers more control over their data. Imagine a scenario where you own your credit history and can selectively share it with lenders, rather than relying on a centralized bureau that holds all your information. Additionally, regulators are increasingly scrutinizing credit bureaus for unfair practices and data breaches. New laws and regulations could enforce stricter standards for accuracy, transparency, and consumer rights. But no matter how the system evolves, one thing remains clear: your credit score is a powerful tool, one that can open doors or slam them shut. Understanding its dark side is the first step toward taking control of your financial future. The credit score system was designed to streamline lending and reduce risk, but it's become a double-edged sword. Its flaws, bias, manipulation, and vulnerability highlight the importance of financial literacy and advocacy. As consumers, we must stay informed, regularly check our reports, and push for reforms that make the system fairer for everyone. Because behind that simple three-digit number lies a complex web of data, algorithms, and human decisions, some transparent, others hidden in the shadows. Thanks for joining us on the mechanics of money. If you found value in exploring this topic, consider sharing your thoughts or questions in the comments below. Until next time.